handout, and I'm going to put on for 2, do the multiple choice. Yeah, we'll put this as number 3. All right, so let's jump into 5, 6, 8. I think we stopped here. You know that because I wrote stop. Okay, I think it's page 12. Yeah, page 12. Okay, so take the stop out. And number 6. Sufficient appropriate evidence. So we say sufficient. Oh, let me put it down here. Monitor needs to obtain sufficient appropriate evidence to support their opinion. Yeah, give me a second, I'll clean this up. Okay. Oops. Now, we say sufficient, we're talking about a quantity. And appropriate is, well, it's actually sort of a quality, but it also be, you think about it as relevance. It is a quality, though. So in other words, you know, sort of like this. So you need to get a oops. Enough good evidence to support an opinion. That is not how you spell opinion. And if you can't, then you'll end up giving them a disclaimer. So whenever you do an audit, you're looking for a sufficient appropriate evidence. Enough evidence to support your opinion. And that's what you, and your work papers, all your work papers are a collection of all this evidence that you believe supports your opinion. If you ever get sued or something like that, you'll pull that out in court and say, look, we got all this evidence we got to support our opinion, you know, and it's proof that you have enough of it to do it. Okay, now not all evidence is the same. And we're talking about documentary evidence. This is just documents. And not all documents are equal. I'm going to build this. Okay, the best evidence is held by, it's created by a third party, and the third party holds it. In other words, it comes from the third party. Medium evidence is created by the third party and it's held by the client. Actually, I'm going to do this a little differently. I'm going to color coordinate this as yellow. The worst evidence is made by the client and it's held by the client. Now, let me give you an example of, first to do with medium evidence. Medium evidence. For instance, a bank statement sent to the client. So this would be, the third party, would send it to the client. So a bank statement, this looks funny. So a bank statement sent to the client would be medium evidence. The third party is the bank, in this case. And the bank sent the client has the bank statement. Now, one of the things we always try to do is move evidence up, make it better. So, okay, there's a bank statement that the client has. It's medium evidence. It's not bad evidence. This is medium evidence. It's made by a third party. The client is holding it though, so the client has access to it. We're going to move it up. And one of the ways they move this up is they have the bank send the bank statement directly to the auditors. The clients never get it. Well, I shouldn't say that. The clients never get the auditor's copy of the bank statement. The client will have their own, but we, instead of taking the clients, that they've already got their cooties on, we get it sent directly to us, and that moves it up. And the idea, of course, is that if they have the bank statement, they could have tampered with it. But if we have the bank send it directly to us, the client doesn't get the chance to do that, so it's better evidence. So one of the things that we try to do is have the bank statement sent to the auditors. Oops. So this will move it up to the best evidence. So we're always trying to move evidence up to the next level. And some things down here, like we'll sometimes see the worst evidence is the client made and client held. So for instance, a sales invoice. The client makes it, the client holds it. But there are things that we can do with the sales invoice to kind of corroborate it, to move up into the better, and make it into better evidence. So the worst evidence is the stuff that the client makes. And in fact, their cutting rules are that you cannot use that as your primary evidence. The evidence is created by the client, held by the client. You cannot depend solely on their accounting system as evidence for an audit. In other words, you have to have some of this. Okay. I think this goes on the next page. I think this is on page 13. Okay, so examples of documents. So sales order that's created by the client. Sales invoice, this is also created by the client. By the way, why would these two be different? Why is a sales order maybe different than the sales invoice? Someone calls up and orders 100 sweaters. Okay, they make a sales order. Why might the invoice be different?
Can they change the order before?
Yeah, or maybe they don't have 100 sweaters and say, oh, we don't have 100 sweaters, we'll send them 80. So the sales invoice might be different than the sales order. Sales order might be for 100, maybe they don't have it, send them 80. So there are reasons why the sales order might be different than the sales invoice. But still, these are both created by the client. And generally speaking, they're not very good evidence. A vendor invoice, this is when we purchase something. Now that's created by vendors. Now this is a third party. There's some clever way to do this. So this is a medium evidence. Vendors a third party. It's held by the client. Receiving report. This is when they receive something, they will record it. They received it. Now, two documents that are very important to us when it comes to sales or purchases, and probably the most important one is the bill of lading. The bill of lading is a document that's hundreds, probably thousands of years old. Bill of lading, what they are, is when something is shipped. Notice when you ship something, you're shipping something UPS. You'll take whatever it is you're shipping and you give it to UPS. Now, UPS doesn't own it. They're taking possession of it, and basically there'd be a bill of lading for that. But they're taking possession of it, but they don't own it. They don't have what they call title to it. Okay, so it's this is a kind of a tricky legal thing that someone has something that belongs to somebody else in their possession. So, bill of lading, when something's loaded on a truck, whoever is loading it, and the people who are, the usually truck driver who is taking it, they will agree upon this bill of lading that this is, we had these packages, these boxes, whatever, they had this much in it, and it'll be a list of stuff that is then put on that truck. That's a bill of lading. Okay, and usually if they don't have dollar amounts or anything like that, there's no reason to it. It's simply saying a list of things that were put on the truck. They don't have to check the values of them or anything like that. Usually it's whatever was put on the truck, and whoever's the shipper will sign it, and whoever is is taking it, the trucking company usually, they'll have signed it too. And so this is a bill of lading. So this is kind of an agreement that we put this on the truck. You have possession of it. You don't have title to it for the trucking company, but that you're taking possession of it. So it transfers the possession of it. And it has this description of what it is, signed by the carrier in the shipping department. They'll have the seller and buyer's addresses, and the prices are usually not included, they're usually not necessary. If something gets stolen or something like that, then they'll work out what the value of those things were. But the bill of lading usually is just a list of things that are put on the truck. Now, this is a very important document. First of all, you can make this into the best evidence by asking for the bill of lading from the carrier. So you get a sales, you probably would do it from a sales order, but a sales invoice that says, okay, we sent these 100 or 80 sweaters or whatever it was. That should be on a bill of lading somewhere. So you should be able to tie this invoice into a bill of lading. If you need to, you can actually get it from the carrier, this bill of lading, as evidence, and that would be a third party. This is the worst evidence, created by the client, held by the client. It can be moved up to the best evidence by getting a bill of lading from the carrier. So while the sales invoice is maybe not very persuasive, this can lead to if you tie this in with the bill of lading, now it becomes better evidence. And she'll kind of start to move the evidence up. All right, now there is another document called the proof of delivery, and everyone's more familiar with this nowadays than the bill of lading. Proof of delivery, if you ever get something from Amazon or I don't know, Walmart or whatever it is, they always take a picture of it. That's kind of like their proof of delivery. Here's a picture of it. Mine is kind of funny because every 10% of the time I think they make so many deliveries. I have an apartment building next to my house, so that's like a picture of it. Oh, it's in the apartment building next door. So I go over and pick up my package in the apartment building. But basically, when they take that picture, they're saying, "Look, this is a proof of delivery, proof that we put it on your door. Here's your door, and here's the stuff that we gave you." So that's a proof of delivery. Now, the reason why I say that the proof of delivery is not as used as much as the bill of lading. The bill of lading proves that something was shipped. Now, it may have been lost in shipment, maybe the truck burned up or whatever it is. But the bill of lading, excuse me, is proof that the client is not lying, basically, that they actually loaded something. Yeah. A lot of times they'll have the bill to the party for the charges. That'll be on there too. Sometimes they won't even ship it unless they have cash. Okay. Oh yeah. When I was at as a side note, when I was at Navistar, we had an engine plant that's in Melrose Park. I think it's still there. I'm not sure if it's still there or not. In Melrose Park, they had an engine plant, and they also did a lot of experimental stuff with the engines and that. And so they had a lot of these stuff that come from shippers that are all over the place. And these a lot of times these people who are trucking, they don't have an account with us or anything like that. So they would say, okay, look, you got to pay it up front, because we're not going to, deliver it to you unless we get paid for it. And if you don't, we're not going to drop it off. So we had to have cash. We had a petty cash account that had $10,000 in it. And there were sometimes that it was replenished, like once a day or something, because they'd have a bunch of deliveries come for people that we didn't have accounts with, and you had to pay them cash. So yeah, there is sort of a the only thing the shipper has is their proof of that for their charges. So proof of delivery is, well, there's nothing wrong with it, and it can be good. The bill of lading is an important one. The bill of lading is important because it shows the intent and the action of the client to actually ship the thing. It isn't like they just made a sales invoice and didn't ship anything out. If it's tied to a bill of lading, it shows, okay, here's 100 sweaters, and there's a bill of lading that has 100 sweaters on it. That way, the sales invoice, now that used to be the worst evidence, was something you couldn't really rely upon, now becomes much better because it's tied into this bill of lading. It at least shows they shipped it. Now, as far as proof of delivery, it may not have gotten there, and you have to work it out with insurance companies and stuff. But the bill of lading is an important one because it shows that there was actions taken by the client that support, especially these documents that maybe by themselves are not very persuasive. Okay, I gotta change one of these. You'll notice that there's two sales invoices. A and D are sales invoices. Change this D to a vendor invoice. Sorry about that. I just sneezed. I know I'm not crying because I'm so moved by auditing. I was doing cleaning up the yard today and allergies. So if you change D to vendor invoice, we will go through these. Okay. So let's rank the following. Sales invoice. By itself, what kind of evidence is it? Or sales order, I'm sorry, sales order.
It's the worst type of evidence. It's made by a client.
Yep. Made by the client, held by the client, and this will be the worst. Sales invoice.
Same thing. It would be worse because it's held by a client, made by a client.
Yep. And packing list. It also be the worst, made by the client too. Okay, how about a vendor invoice? So this is coming from somebody that we're buying something from, and that vendor, whoever it is, sends us an invoice.
I think it's gonna be best because it's made by a third party, or would it be medium?
I mean, medium most likely. It depends on who holds it, but most likely the client will hold it. It would be medium evidence.
Okay, thank you.
We could, maybe you're right, though. We could go to we could ask the vendor to send one directly to the auditors. I don't know if they would, I don't, that's probably not very common. Bill of lading and proof of delivery, where would those be?
Bill of lading, best
Yeah.
evidence.
Yeah, and this, yeah, especially because you get those right from the third party, which would be the carrier. Now they would probably have copies of the bill of lading. They'll have a copy in the it depends if you're using the client's copy to say if the client held it or if the carrier held it. So it'd be best if you got it from the carrier. Let me put this in. And you could do that. And if the client holds it, it'd be medium. Now, as far as proof of delivery, most likely that's going to come from the vendor, not the vendor, the carrier. Sorry, I'm having a sneezing fit here. Okay. So again, not all evidence is the same. And, having a ton of this evidence really doesn't do much for you. Say, well, we have every sales order they ever did. Well, that doesn't really mean too much. Until you can tie it into these other, some other evidence, it's not going to mean too much. Okay. Management representation letter. On the last day of field work, the auditors will have the CEO, the CFO, sign a representation letter. So the last day of field work, the letter will state that is responsible Whoever said the management is responsible for all representations made for the, and what they mean by anything, any information. So as for all information, let's say. So then you take responsibility. Anything that the auditors relied upon will be in that letter. It will also say that management is responsible for the financial statements. It will say that they're responsible for internal controls, and it will, have everything that basically they relied upon. And this is done. This is usually the last thing that they do when they go out the door. Is the CEO and CFO sign this letter. Now, what's the point of it? The point of it is that you get two people's names on this, and they'll be on the hook basically for whatever is in that letter. This does not replace evidence. So you can't rely on it as evidence. Okay. Let's change that. Let's turn that back to black and let's make it yellow. No, don't do that. No, don't do that. Okay. So, and we don't do this instead of evidence. So it isn't like we can just say, okay, we'll put everything in the management representation letter. We don't have to test for this and this and this because it's going to be the management representation. It doesn't. It's not like that. It must be. It is simply there to remind them of their responsibilities for it. And if they don't sign it, so what if one of them says, "I'm not signing it," CEO or CFO? If either one of them says they're not signing it, they generally get a disclaimer of an opinion, because all of a sudden there's something that you relied upon that is not that they're going back on. Certainly you'd ask them why they're not signing it, but if they don't sign it, if they refuse, if one of them refuses to sign it, generally they get a disclaimer, because now you don't know. You don't know if you can rely on what they've told you and what is they've represented. I'm so sorry, I'm sneezing like crazy. So management representation letter, generally speaking, this is there to kind of make sure that they've given you everything and that they are going to put their name on that they have given you everything. Lawyer letters. These are letters come from the client's attorney. Okay, let me clean this up a little bit. Lawyer letters come from the client's lawyers. They'll include all material legal issues that the lawyer is handling. And It'll only be the stuff that the lawyer is handling, by the way. Wait a minute, what did I do here? Okay. So it won't necessarily have every legal aspect. For instance, if someone has a lawsuit that they haven't filed yet, someone who comes in your store and slips or falls down and says, "I'm suing you," and runs out the door. If they haven't filed a lawsuit yet, if the lawyer isn't involved, they're not going to have any information on it. So that's the first thing. It's only for those things that the lawyer is actually working on that they're going to be able to give you some information on. Your primary evidence comes from the client. You ask the client, what are the lawsuits out there? And the client should tell you. And the lawyer letter, let me get back to the lawyer letter. The lawyer letter will confirm I should say corroborate. That's not what I wanted to do. I turned my camera back on and I did something stupid. So it'll corroborate or refute. I'll put that in there. If the client was lying to you. So your main people you talk to are going to be the client, but the lawyer letter will corroborate or refute the information given by the client. So if they say that this lawsuit might be settled for $10,000, the lawyer letter should say that. This is also one of the, I don't know if I've ever seen this on the test. Maybe I have, I don't know. But the another thing about the lawyer letter is because the lawyer will say, well, you say, we want to know all these material facts. The lawyer says, okay, well, what's material? What dollar amount are we looking at? $500, $5,000, 50, what are we looking for? So this is one of those strange cases where you will work out with the client what is material. And usually, you come to some conclusion. This is not what you think is material for the audit. Usually it's at a lower, the materiality is set lower so that, maybe your materiality is 50,000, maybe you say everything is 10,000 is material for the lawyer because there might be multiple lawsuits. So, but the lawyer's going to want to know, well, are you looking for everything? Especially you get into these large companies, you can imagine someone like Walmart, they probably get dozens of lawsuits every day. You can imagine what it's like to pour through that and see what's material and what's not. So, it's perfectly standard to say, well, how much is it? What are we talking about as far as material? And you'll work out with a client, but again, this is not the same as materiality for your audit. It's usually much lower than that. Okay. External confirmations. And these are kind of bunched up. Hold this. Oh, that's why they were bunched up. What else do? Okay, the US standards. Confirmations are required. International standards. Not required. So US standards, you are required to get accounts receivable confirmations unless you have a really, really, really good reason. You are required to get accounts receivable confirmations. International standards, they're not required. That doesn't mean you don't have to get evidence. It just means that you have a choice of how to get evidence. So for instance, you may look at the, bill of ladings or the proof of deliveries. You may, use this instead of getting confirmations from the client, the client's customers. Okay. By the way, just so you know, here's what we're talking about. The client, let's say IBM. IBM has accounts receivable. They've done work or sold something to someone. They have an accounts receivable. You want to know if that accounts receivable is valid. Even if you have shipping documents, there may have been some elaborate scheme where they had it shipped to a warehouse that, so you may want to, for US standards, you must get a accounts receivable confirmations, at least for some of the clients. So of the client's customers. So IBM has a customer. You want to see if that accounts receivable is valid. You're going to send a confirmation to the customer, IBM's customer. Let me see if I can write this out. I'm babbling here. Okay, so confirmations are sent to the client's customers to verify accounts receivable. Oops. So if this is IBM's customer, you would send them a confirmation. Okay, negative confirmations. Now, notice when you send a confirmation letter out, it'll say, do you owe this amount? Do you owe $10,000 to IBM? Yes or no. And then, do I have one on here? Do I have an example? I took out the example. I'm an idiot. Okay. Error. Okay, so you send this out, it'll say, do you owe $10,000? And it could be yes or it could be no. Now, the ones that you're interested in are the no's, right? If they say, do you owe $10,000? They say yes. Okay, that's evidence. I mean, certainly it's evidence, but what you're really looking for are the ones that are no. No, this isn't right. They sent me the wrong order. They sent me, whatever it is. So the ones that are no are the ones you're probably more interested in than the yeses. So this brings up a kind of two different tiers of confirmations. You can request that all of them come back, or just the negative ones. So those are kind of the two that you're looking at. And we'll talk about those in a second with the better evidence and all that. So negative confirmations. Negative confirmations. Only disputed confirmations need to be returned to the auditors. So you say, is this, is this amount correct? If no, please explain why and return it in the envelope we provided. If yes, please disregard this confirmation. Positive confirmations. Ah, yes and no. Okay, so we have these two different types of confirmation. The positive confirmations are yes or no. If no, please explain why. Place all confirmations in the envelope and send them back to the auditors. Which of these confirmations do you think is better evidence? The negative confirmations with only the no ones returned, or the positive ones with the yes and no return? Which is better?
The negative confirmations?
Actually, the negative confirmations are not going to be as good, and I'll tell you why. Positive confirmations, we get all of them back. The negative confirmations, you can't really, the ones that are not returned, you can't make any real reference to whether those are okay or not. Maybe you sent the confirmation to the wrong address. They moved. You didn't know that. They moved and you sent it to the wrong address. They never got it. So you might think that, everything's okay if you were to count, it didn't get returned. They just never got it. Or maybe they got it, looked at it and said, oh, they're idiots. This is stupid. Throws it in the garbage can. That you don't get it. You think, okay, everything's okay. When actually it's not okay. They don't think it is. So the negative confirmations, the problem with them is that there could be a lot, or maybe they did send it back and it got lost going back to the auditor. That's another possibility. So you can't really make any kind of judgment for those ones that are not returned. All right. Now, the positive confirmations are better evidence. You're getting all of them back. They have to have an answer on them, yes or no. If they don't, you send out 100 of them, you get 87 back. You call the people up, oh yeah, it's right here. Yeah, yeah. Oh, I mean, I'll look at it. They fill it out, and then you get 96 of them. There's still 4 out there. You track it down, and finally you get to the last couple people, and you say, okay, do you have a fax machine? Okay, right. So put it on the fax machine and send it over to us, and you have to track them down. It's much more expensive sometimes to do the positive confirmations. Okay. I was just talking to myself for a little while there. So the positive confirmations are the best, but they are more expensive. Negative confirmations, while they still are coming from, there would be medium evidence. because you don't know some of them that you're not even getting all of them back, but they are less expensive. Okay. I'm gonna add something here. Negative confirmations are usually done, when are they used? For oops. So these are usually used for smaller dollar amounts with greater quantity. Usually use the negative ones. So smaller dollar amounts and for a lot more of them. And the smaller dollar amounts that, even if some of them aren't returned, they're probably not material. Positive confirmations, these are the more expensive ones, these are usually used for higher dollar amounts and fewer quantity. And these, you might insist on all of them being sent back. Maybe they're material. If you're talking about millions of dollars in accounts, you'll take the time to track those down, because any one of them being, fictitious could be material. So negative ones are for smaller dollar amounts. So that even if they don't send one back, it's probably not that big a deal because they're probably not material. Positive ones, especially if they're material accounts, you're going to want to see all of them come back, because the high dollar amounts, any one of them might be material. There's also the cost factor, though. And down here, the auditor would be equally satisfied with either the following types and amounts of evidence. Okay, so we're equally satisfied. These are equally satisfied with these two. So if we had 500 negative confirmations, they cost us $3 each, we would be happy with that. Now, positive confirmations are better. Hey, I don't want to get bolded. So we need fewer of those, right, to be just as happy, but they cost more. Which type of evidence will we probably end up using if we're equally happy with either of these?
Positive confirmations.
Probably not. You're probably going to end up,
Well,
if you multiply these out, this one would cost you, where am I at? 500 times 3 is 1,500?
1,300. And the other 2,000.
Yep. Oh, whoa, that's way too much. Ignore those crazy numbers I'm writing up there. Yeah, it'd be cheaper to use the negative confirmations if you're equally happy. Another thing about auditing is we don't always get the best evidence we can. Sometimes it's just too expensive. And if we're equally happy, in this case, we would go with the negative ones. Everything else being, they're going to be the same. And one thing too about, someone says, well, why don't you just get the best evidence for everything? Because it's more expensive. And if you think about an audit, basically the way an audit is set up is you have your costs and then you add some profit onto it when you do the audit. And it's also to the benefit of your client not to choose the most expensive evidence and pass that cost on to them. You're also looking to be more efficient in your audit, because it will usually lower the overall audit fee, rather than getting the best evidence. So auditors don't always get the best evidence. Sometimes it's just too expensive, or more expensive is a better way to put it. Okay. Working paper audit documentation. Working papers also, these are also called work papers. Oops, what did I do here? Work papers are the evidence that supports the auditor's opinion. And again, everything is documented. Everything is documented in the work papers. You document everything you do. And I think I told you last time, about a third of auditing is documenting. There have been, when I was doing internal auditing, there was times that I spent the an entire day writing up audit points. That's, you want to make sure you get it done right and all this stuff. And, everything is documented. You have everything in there, all the evidence, all the whatever that you're doing, backing that all up. And, usually, especially when I was doing internal auditing, you'd bring it to management and say, look, here's the problems. And they want to see, well, how'd you come up with that? Okay, you're saying that these are not being whatever. How'd you come up with that? And you'll go into it and explain that why. But you do the same thing for external audits, that you will get all your ducks in a row. Basically, you will have all the information there to support your opinion. Ownership of the work papers. The audit firm owns the work papers. Work papers are not usually shared with a client. And this is one thing you tell the client, look, this is our evidence, but we do not share that with the client for a number of reasons. You don't want them to know your materiality. You don't want them to, there may be personal information. You want them to see what testing you're doing. So you don't share these with your client. So they're not usually shared with the client. So the audit firm owns the work papers. They're their evidence for going into a court case, basically. And they own them. Now, the client said, well, we paid all this money. We want to see the work papers. And, again, you don't want them knowing the materiality that you're looking for, the testing you're doing, all that kind of stuff. They don't.
It's like sharing your secret recipe.
Exactly.
So you don't show them, you don't show them what you're testing them on, and like you said, materiality, personal information, because then they know how you audit.
Exactly.
So it's like good recipe, yeah.
So your materiality is, $200,000. Well, now as long as we keep it under 200,000, we can, So you don't want to ever give that out to them. Now, it could be that there's an actual problem that you came across. Let's say that there's a material misstatement in an invoicing or something like that they should need to correct. You can give them selected parts of the work papers with the evidence that they need so that they can make a correcting entry. Especially for correcting entries, you will usually share that with them. Like, this is how we came up with this, and you may want to do the correction based on this. So that it isn't that you won't ever share anything with them. You will if they need it, but you just don't say, here's the work papers, here's your copy of the work papers. And in fact, we actually even guard them, and going to the next part is the confidentiality of the work papers. We own the work papers. That doesn't mean that we can, post them on Facebook and have everyone take a look at them. Oops. The others have a fiduciary duty to keep the work papers confidential. You don't want, you don't, even though you own them, you don't put them on the internet or anything like that and have people look at them. So these are kept confidential. And they actually have rules on who can actually look at them. For instance, people reviewing the work papers can look at them. So if you have somebody who's not on the audit, but who's reviewing the work papers before the audit's put out, or even after, they are allowed to do that. Government agencies that are looking to review, for instance, the PCAOB, they might be checking to see if you are following their standards. They have a right to look at the work papers, but they're also under that same confidentiality that, if they're looking at IBM's work papers to see if the IBM audit was done, up to standards, then they will, they're also under that fiduciary duty not to share that information. So whoever looks at them is also under that same fiduciary duty. Okay. Retention of work papers. AICPA, 5 years. PCAOB, 7 years. I think I already told it. I think I did this already, didn't I? I can't remember. So this is for non-issuers. And for issuers, actually, technically, the PCAOB requires you to follow the AICPA standards. So you are required to do 5 years, but in this case, 7 years of the PCAOB is longer. So changing the work papers. For non-issuers, it is 60 days after the audit. For issuers, oops. It's 45 days. So changing the documentation is when you are taking, usually they count this as when you're taking things out of the work papers. Oh, wait a minute. And why would you take things out of the work papers? It's possible to take things out of the work papers, things that are not relevant. Sometimes you'll have these kind of wild goose chases. That I don't know. I think I told you that I had a guy at one of my audits said there's all this, there's this, they're selling off equipment, and this equipment, the managers are all taking all the money and all this kind of stuff. It was completely nonsense. Some rumors or something that they had going on there. Every piece of equipment we ever looked at and that they said was being sold off for management was documented, and most of it was scrapped anyways. But regardless, it was, so you run into these things where you're investigating specific people. Sometimes you don't want to have that hanging around on the work papers, that if you did come up that this is absolutely not, irrelevant to the audit, it has no bearing on the audit, you can take that out. If for no other reason, then you don't want that to get out that someone was investigated for something that obviously didn't happen. So sometimes you'll clean them up. You might clean up some personal information, things like that are not relevant to the audit. Now, after 60 days for the AICPA and 45 days for the I think I said that wrong. AICPA is 60 days, PCAOB is 45 days. After that period of time, you can always add things. So as information comes up, you can add it in. So IBM, after the work papers are done, you did the audit, things are still happening at IBM, then past the 45 days or a publicly traded company, you can still add stuff. You just can't take anything out after the 45 days. So you can always add to the work papers. After 45 days, you can't take anything out if it's publicly traded. If it's not publicly traded, 60 days, you can't take anything out. Oops. Okay. Review problems. Okay. So quantitative and qualitative materiality. During the audit, they figure out that there is a $50,000 understatement in an account. The overall materiality level is set at 70,000. Is this quantitatively, in other words, dollar-wise, is this material? This $50 misstatement, $50,000, sorry, $50,000 misstatement, is it material? Quantitatively, it's not. It's less than no. $50,000. So quantitatively, this is not. Now, qualitatively is when there is, you look at what is actually being, what this actually this does, if it's management fraud or something like that, that is beyond this quantitative. If it's already quantitatively material, it doesn't matter what the qualitative is. But if it's not quantitatively material, like this one isn't, is it qualitatively? Well, one thing we're going to do is see what it would look like if they had made them correctly. Notice that the expenses would be $50,000 higher. Spacing here. So this would be 2,000,000, 78 plus was that 830. Talking to myself there for a little while. So is this qualitatively material? We know it's not quantitatively. It's not 70,000, it's 50. Is it qualitatively material? Oops. Yeah, this would change a,
Yeah, it was changed, net income to a loss, actually.
yep.
So it is. Yeah.
So this would be so while it's not quantitatively material, it is qualitatively material. I wish those words weren't so closely, didn't sound so much alike. Net income into a net loss, or you could also say it reverses a trend, or reverses a, depending on what it is, but it changes the net income into a net loss. And a company that's profitable is deemed much differently than a company that is not profitable. So this, while it would not be materially scratch that, it would not be quantitatively material. It is quantitative or qualitatively material. I'm talking nonsense. It's not quantitatively material, the dollar amounts. It is qualitatively, because now you have a company that went from being a company with income to a company with a loss. Okay. There's one of these on the test, by the way. Review problem 2. Flow of information. Do we already do this? I can't remember. So yeah, we have source documents, and these source documents end up going into journal entries. From the journal entries, they go to the general ledger, to the trial balance, to the financial statements. So generally speaking, if you want to make sure that everything is included on the financial statements, now, let me put this in here. Hold on. For completeness, oops, the testing goes this way. Do they have all the invoices included in the financial statements? You test from the invoice to the journal entries, general ledger, blah, blah, blah. You get the idea. So you want to say that everything is complete, everything is recorded, everything is in the financial statements. You're also going to do testing the other way. And that is existence. That is everything, do these amounts that are on the financial statements, do they actually exist? And for that, you're going to go back. So you'll start with the number on the financial statements. Okay, accounts receivable is this amount. We'll go back to the trial balance, go back to the source documents, the shipping documents, and all that kind of stuff to see if those accounts receivable are actually valid. So you're going to go the other way. So completeness is going from the source documents And existence is going from the financial statements. And you're going to go both directions usually. And these are the two most common tests that we do in auditing. Completeness and existence. Is everything included? And if they have something in the financial statements, did it actually happen? Did it exist? Did it, something's called occurrence will be in there too. Okay. So here are the questions. Tracing source documents to the trial balance would most likely be associated with which type of assertion below? So source documents. To the trial balance. What kind of testing are we doing? I'm gonna shorten this up a little bit.
Completeness?
Yep. Yeah, this would be a completeness test. You know, are the source documents in the trial balance? Tracing the journal entries to the source documents. Okay, so
That would be existence.
yep, good. Oh, you know what I should do? I should make these color coordinated like this up here. See? Yep, that would be existence. Yeah, you want to see that, you know, these journal entries, that they're source documents that back up this journal entry. You see, do these journal entries, do they exist? Which of the following would most likely be associated with the existence assertion?
Tracing the shipping documents to the financial statements.
Actually be the other one. Let's see here. So existence is going from the financial statements back. So tracing from the financial statements to the shipping documents, just to, yeah. So these things in the financial statements, do they exist? They say their sales are whatever, $5 million. Do these sales exist? You go back to, you know, the shipping documents to see if those sales actually are there. Which is probably the most likely to be associated with the completeness. Oh, this one's a little trickier. Tracing the sales journal to the source documents or sales journals to trial balance. Okay, so which one are we looking at? Completeness? Wait a minute, I should make that yellow. Okay, so completeness is sales to the source or sales to the trial balance. Okay, so here's the sales. Here's a sales journal. So which way are we going to test it for completeness? Let me go forward here. You know, if we're doing completeness, we're going left to right. So which one would it be?
It would be B, tracing the sales journal to the trial balance.
Yep. Very good. Oh, hey, we're done with this thing. Woo! Let me back this up so you can take a look at the answers. And this is one of those things that I'll guarantee you there's gonna be something like this on the CPA exam. These are existence and completeness are heavily tested because that's a big part of the financial statements. Okay, I'm going to go ahead and send out the multiple choice questions. And we'll start the poll. Uh, no, 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 I think they changed it. Hold on a second. We gotta figure out where are they? Polls. There we go. Okay. Sorry about that. So I sent the I sent the multiple choice questions to the email. Got my nope. Did you guys get yours yet? The I'll go ahead and put this up until you guys get them. Yeah, so the multiple choice question should be in their email if you take a look. Oh wow, we're late.
I'm trying to open my email right now, actually. And I've lost the polling question, the answer thingy. Where is it? Sorry, I can't find it.
Let's do it. No one's actually answered it. I'll do it again. Oddly, I have to go back. I have to stop sharing to start a poll. Hopefully it'll show up. They changed this in an attempt to these newfangled things, but they you know it's okay. It looks like mine went through. Hopefully yours have gone through now for the email. Oops. This will be the only, we're not gonna do anything else, Dave. We're just gonna finish this up and I'll send out the exams after class.
Hey, Professor, we can't see the polls where we have to give answer for the multiple choice questions.
You just can't see them? Shoot. Let me,
No, you can't.
if I'm relaunching it. Can you see it now or no?
Yes, Professor, we can see it.
Okay, good. Sorry about that. Let's see. I'm gonna change the monetary unit sampling. We're gonna change that to the 8th. We're not gonna get through that. We're not gonna do that. Is you still working on the multiple choice?
Professor, I already submitted mine. Did you get it? Because I'm not sure if it worked.
Oh, you know what? I can't tell.
I also submitted mine.
Yeah.
Generally, there's not someone who's still working on it. You can also just put it in our private chat to me. It doesn't actually, I can't actually tell who, it's an anonymous poll.
Okay.
I only know when the results are, and that's just who actually participated in. It doesn't say who did what or whatever. I got 7 out of 8 so far. Is anyone still working on it? If you are, that's not a problem. I'm just, I don't want to close the poll if someone's still working on it. Okay, I'm gonna go ahead and close it then. Okay. Let's go through these. The first one's a trick question. The predecessor auditor never has to contact the successor. The successor has to contact the predecessor. Here's an actual CPA question. Okay, number 2. 8K. Midline statement is correct relating to the successor authors must be communicated with the predecessor. He is correct. Good. You know, the risk that auditor will not detect material misstatements in the financial statements. Regard to minimize risk that relies upon substantive costs. Yep. Abnormal fluctuations in gross profit. It's just a need for extended audit procedures for sales of analytical procedures. Yep, good. Hey, someone picked E for 6. There's no E. I'll say E is a It's D, most likely. To test for unsupported journal entries. This should be from, unsupported means that they're not. So journal entries that aren't supported. You're gonna go from the journal entries back to the source documents. I'm gonna give you this one because I think whoever picked E probably meant B. Since there is no E. All right, 7. Sample file of the shipping documents. Yes, completeness. Tracing source documents forward to the ledgers, most likely to switch of the following. Same. So source documents to actually anywhere is going to be completeness. This one better be D. Yeah, this one, if you cannot get the sufficient competent evidential matter, you should not do the audit. And an example of that would be a business that does all their business in cash and you can't actually, you don't have any documents to look at. All you have is cash changing hands. It's very difficult to know exactly what's going on. Okay, question 10. To test the existence, the auditor would sample from, yeah, the general ledger back to the source document. Does it, do these actually exist? Good. It ain't bad at all. Only the one, and this one's kind of a tricky one too, because it says predecessor. Okay, very good. Well, so I'm gonna close this. Wait, no, I do want to stop sharing, and then I can save it. What is this, week 9?
Yes.
And this is 5 and 6. Oops. Okay, very good. So this will be it for the night. I'm not gonna take the last 15 minutes. So what I'm going to do is I'm going to send out the let's say by 10 o'clock. I'll try to get out before then. And it will be due on November 1st. Okay, so I'll send it out later on tonight. I'm going to go over just to make sure there's nothing crazy in it. And then it'll be due on Friday, November 1st. Any questions? Okay. Well, have a good evening, and I will see you guys next week. Look in your email for the exam will be sent out shortly. All right. Good night, everyone.
Good night.
Good night.